Hi everyone, welcome to the investing webinar. Let's just share the screen. Lots and lots and lots to cover, so I'm not going to waste any time on small talk. First things first, let's start off with why everybody's here. The vast majority of you here, you're going to go from everywhere from pensioners to 20-somethings. From the messages that we've had, it's usually people who are disappointed with their financial advisors, disappointed with the investment trust they've invested in, or disappointed with how their pensions are performing, and they want to just get the education to ask the right questions, or if they're picking stocks themselves, know exactly how to do it and how to do it professionally. And that's where I come in. Okay, you might be a total beginner, you might be in your 70s and an experienced wealth manager. And like I said, grab a pen and paper. First things first, it's not individual financial advice because I don't know you individually. That's what that thing says there. I also have no conflicts of interest with you. I'm not a stockbroker trying to get you to use my brokerage services, and I'm not a retail fund manager trying to get you to use my fund instead of somebody else's. My interests are that you do well. I launched a campaign for 1 million to teach 1 million people how to be better investors recently, and that's what this is part of. It continues from all the books that I've written, and you can get free copies to download of these. I'll give you the links at the end, and it's just part of the free education that I provide, as well as on my YouTube channel, Telegram channel, and everything else. Okay, and one of the things that we're going to be doing, which is new for this webinar, is looking not just the stocks that are in my son's junior ISA. You can see him there. He's a chess whiz already, but also we're going to look at how AI can improve upon my picks, or at least show me companies which I hadn't looked at, and I'll tell you which ones I like, which ones it's picked, which ones I own as well, and more importantly, the methodology you should be using yourselves for selecting stocks, which means some of the things we will go through in this webinar are just having simple flow charts like this, what to do with your portfolio, what to do with your cash. I'll take you through this later, so don't worry about taking photos of it right now, and also how you should be selecting stocks by ensuring you sift through 10,000 companies, not just ones that you've heard over the shoulder as somebody at a pub, because that is not an efficient way of picking stocks. Stocks, after all, are individuals. They represent individuals who you've asked to look after your children's inheritance or your retirement, so you should look as many CVs as possible. Most of my SIP and ISA is US equities. I know we've got people here from America, from Latin America and elsewhere. So Simon's from Devon, for instance. Devat, we met in Westfield. We did. Thank you. Do drop me an email anytime. Okay. Mid Wales. If it's sunny, you are a lucky, lucky man. Okay. And beautiful Shropshire. So, declaration of interest. Some of the stocks that I mentioned I own, I will tell you which ones they are, but they're big companies. You're not going to move the dial on them. I'm not going to talk tiny penny stocks. Okay. And for fun, and I did something with ChatGPT on the BBC, and you might have seen me do this on the Beeb recently with Sally, where we're talking about UBS's results. I put it, there it is. It's on my YouTube channel anyway. I fed it all through ChatGPT, the earnings statement from UBS. And I've got ChatGPT 4 Plus with plugins, which actually also give me access to the internet on there. And I asked it, right, how do these earnings look? And then I told Sally that, and it came on air. So I'm a bit obsessed. Okay, so I'm going to use some of the AI part just to see, does it improve my picks? Does it double check my homework, which is what I really want it for? So when I feed all this into AI, which is the thing I'm doing more of now, does it come up with the same companies as me? And if it doesn't, does it come up with good ones? Or does it say the ones that I picked, there might be problems with it? Okay, so we're really using not just my brain, not just all the data and the research, but you'll be pleased to know we're using AI as well now. So that's new as well. I'm going to show you how to do it. I want you to keep up with all of this. In fact, it was so popular, my experiment, and what happened on the BBC, that Business Insider magazine picked up on it. And they wrote a whole column about me, May the 11th. What is that? Just a week ago. So they wrote this massive column out, which was fantastic. And they're going to do a follow-up. And I've got a call with, this is out of New York, I've got a call with a company out of America as well soon, because they really want to take this further and what I'm doing with AI and how we're using it for stocks. So I'm going to give you all of this in this webinar, all right? You're going to learn all of this, what it we do, and it's going to be very practical, because I'm going to give you stock names and I'm going to give you processes. They're the two things you need: stock names and processes. I'm going to give you fish, and I'm going to teach you how to fish. But like I said, I've got a lot to cover. Luckily, if you've been following me on Telegram, and I hope you're all on my Telegram channel, which is completely free as well, you'll know since January I've been saying get back into tech, unlike many of my hedge fund colleagues who have really called it wrong. I don't want to say they're rubbish, because they're not rubbish. They're actually good people, but I just don't know how they've called it so badly wrong. So hopefully you're on my Telegram channel. If you're not, I'll give you the links to that and links to downloading free copies of free copy of this as well. Okay, so you're going to get all these goodies by being on this webinar, you'll be pleased to know. And yeah, you'll know that I've been banging on about tech stocks. And you might say, wait a minute, you get paid the big bucks for saying Apple, Amazon, Alphabet, and Microsoft? Yeah, sometimes that's what it is. That's where the money is, and it's where it's been. Let's just start off with the broader market. So the S&P 500, hopefully you can all see this very, very clearly. Neil says, sunny. Yes, Glasgow. I believe you. I believe you. Got everybody from Devon to Glasgow. I've been to Glasgow. I did a book launch there many years ago for what was then Halifax Bank of Scotland. I love it. So much fun actually out there. So you look at this, and we've broken out of that downward trend, and we're still going there. I do a weekly market update. Now, I'm not being boastful when I say I think it's the best thing I do each week, because, and you might say, well, yeah, your bar's really low, Alpesh. Well, it's not. My bar's really high. It's the best. It's free. It's a free weekly update. It's on my Telegram channel. It's on my YouTube channel. All right. And I'll be doing one today. I do it on Fridays. So it'll probably be a little bit later today, because I've got quite a bit of work to do. So it'll be about 5-6 hours away, if not more. And in that, I update you on the markets and what I think is happening for the week ahead. It's about 10 minutes long. It saves you reading 50 hours worth of material, which is what I read, in order to compress it into 10 minutes and tell you what's important and what isn't. I actually started doing it for my company, as you would for your staff, just so they know what the big man at top is thinking. Then I thought, hang on, this is actually pretty good for everybody in the age of social media. So if you watch nothing else, please just spend 10 minutes looking at the weekly. It's completely free. Okay. And I'll give you the updates on, and it's on Telegram and YouTube, and see that. So I think the monthly momentum is flattening. The weekly's going up. It's all bullish. So whilst this is still up here, and you might get a week or two of profit taking, you know, debt ceiling, all the rest of it, I'm confident we're still in a good, at worst, benign S&P 500 market, which means when we're picking our individual stocks, we shouldn't have a headwind, as long as we're picking the kind of companies which are benefiting from good financials, which is what I'm going to go through. Do you see? So that's where I'm coming from. So each week I look at this, and each week I say to my audience, I say, well, you know, I'm bullish or bearish, or I think it's benign. That means I can get on with and pick some stocks. Okay. And that comes into a broader category, which I want to teach you today. I might as well just start this bit now. Let's start with this flow chart first. I love flow charts, because the more in life you can remove having to constantly think the same decisions again and again, the more productive and efficient you are. So this is one of those flow charts I like, because I don't have to remember stuff. And it's what should I do with my cash, Alpesh? And it's basically this. First things, what's my risk appetite? So I say to people, look at my weekly update. And if you see me looking at the S&P 500 and saying my risk appetite is, I'm a bit risk averse, then you probably want to wait a month, or average in, pound cost average, into the stocks you like. We'll talk about those in a second, over a 3-month period. Sorry, I'm talking really quickly. It's a lot I want to cover. Or if I'm risk loving, at the moment, I'm sort of risk loving with these stocks, the approved filtered list, which I'll go through in a second, volatility under 20%, and the big S&P 500 companies. And quality companies. For me, the quality companies are Apple, Amazon, Alphabet, Microsoft. You can throw in Meta this year for now. Okay, there's some which are quasi-quality, which is, you know, as good as quality, like NVIDIA, for instance. But those might drop in and out. The perennials are Apple, Amazon, Alphabet, Microsoft. Certainly perennials for now. Okay, and if I really want to take more risk, like in 2021, I'll do the odd special situations, and I sometimes put this on Telegram. High volatility, smaller cap companies. That's the decision-making process. Just stops me having to constantly think. We'll go through the flow chart on what you do when something's in your portfolio. We'll come to that later. Okay. And don't worry, I'll be reviewing all of this again. So at the moment, this is benign. In other words, it's neutral to me. I mean, it's pretty bullish, but it's a worst case neutral. So I don't mind picking the stocks I have and getting in right now. Right. So which are those? And I'll come into it. And yeah, I'm afraid, I'm embarrassed to say, it is the obvious ones. But what can I tell you? They've made me a shed load. When we launched the hedge fund in 2004, we set up the UKFC, a regulated company. We had a Cayman equity long short fund. And I kid you not, we had Apple, we had Research in Motion, which was BlackBerry, and a couple of other similar stocks. And day in, day out, we were just sitting there. And I'd say to my colleagues, okay, so what do we do? You know, and that's it. This is it. I mean, capital raised, but we just raised the capital, so we can't go out and raise more. So we're just sitting there and just like twiddling out. I mean, I did a bit of media and TV, but that was the stupidity of the business that I'm in. And again, Apple, I mean, it is. If it's that easy and stupid, well, just bloody well do it, you know? And you might say, you get clients paying you that? Yeah, we get pension funds paying us that because pension funds have got better things to do. Just as I pay my plumber, he's got better things to do. Oh, sorry, I've got better things to do. And he gets paid. I'm a glorified plumber. And sometimes if the glorified plumber just has to buy a little nozzle and stick it on and get paid big bucks for it, so what? You know, I'm happy he gets paid that to do it because I'm busy doing this. Similarly, yeah, it's Apple. And I mean, I'm not the only one. Obviously, it's an obvious one. Jefferies, Rosenblatt, Morgan Stanley. We'll see for how long, but certainly this year. And you'll know from my Telegram and YouTube, it was January that I said, right, time to get back in. And we're up whatever that's up since then. Okay, what is it, 50-odd%? Now, this is the interesting bit. These analysts, and analysts are usually wrong, so don't read too much into this. These analysts, on average, think all the Apple's at roughly 173. It's actually more now since this slide. The highest forecast by an analyst is 210. That one's right. The others, on average, are saying 176. They're wrong. They're pessimistic. They're wrong. They've just got it wrong. Okay. Alphabet, you can see it's rocketed ahead. Even since then, it's gone up even more. And I was looking at the portfolio yesterday, and I was just thinking, okay, we're at sort of ridiculous. There are times in this industry, in this business, you get paid a lot of money for doing nothing, and you put that down to good luck. It's just Alphabet's going up. It's not down to me. It's down to the conference they gave on AI. And thankfully, they're smart people. They kept saying AI, AI, AI. And it's going up. And they are going to make genuine money out of this. They're going to make profits out of this. So this is where we are. These are all the banks who like it as well. So you might say, well, wait a minute, Alpesh. You're saying something which every single bank is in. Deutsche, Raymond James, Oppenheimer, JP Morgan. Yeah, I don't care they're saying it. I'm not doing this because they're doing it. I'm just telling you where we are. And the MACD, the momentum down there, let alone the fact that we've looked at the value growth, income, cash flow, discount cash flow, and everything else. And we really didn't have to do clever analysis on this. We did not need a rocket scientist to help us with this one. That's based down there. Now look at how much it's fallen. And I'm expecting that to go, I mean, that's going to hit an all-time high probably this year. Okay. And that's going to fill our boots. And you're going to say, whoa, just Alphabet? You're not going to give me some tiny little company nobody's ever heard of? No. Oh, well, would you have given it last year? No, because last year, as you watch my weekly updates, you'll have seen I said, oh, markets are falling. Look, this is the big giveaway, the monthly MACD. All right. I mean, I'll let you into a secret. The shortcut, if you want to shortcut all the financials for us, the first thing I'll look at is this. So if this is falling, I'll tell my team, I don't even want to look at the financials and the fundamentals because I'm not going to buy the stock. If this is falling, I'm not going to buy it. Whoops, where's it gone? If that's falling, I'm not going to buy the stock anyway. So who cares? Sorry, I think the arrows on your screen might be multiplying, but that is annoying. I think they sort of, there's an IT issue with that. So that's Alphabet. Microsoft, another one, and you'll know since January I've been banging on about it, and you can look at the YouTube videos because it's all there. So this allows you to then verify, oh, is he telling the truth? Let's just go back to his stock market weekly update from January. It's on YouTube. You just look at it and go, shit, the guy's amazing. Why am I listening to him? Anyway, and I've been telling my family, by the way, just so you know, my own sister, when I said to her, or one of them, when I said buy Microsoft, in Jack, she goes, no, everyone, we have a family WhatsApp group. She goes, no, everyone, markets are going to fall. She's in marketing. Markets are going to fall. And I thought, okay, she's my little sister, so I'm not going to be rude to her. I sort of wanted to email her back and say, do you know who I am? Anyway, I didn't. She'd punch me if I did. But she's missed out on it. So what I'm saying is, listen, my own family sometimes doesn't listen to me. You think they would, or maybe you wouldn't. The rest of them did, by the way. So that's all buys. Raymond James, Piper Sandler. It's a simple, easy one. But, I want to give you a warning. You know, Microsoft fell 31% last year. So don't think you can make the mistake of, oh, I'll just buy it and hold it forever. It can fall 31% in a year, and that's low volatility. It's a 12% volatility stock. There's very few stocks with less volatility than Microsoft. Yet this year it's up about 50% or whatever it is, and last year it fell 31%. My point being, don't think that there's no risks involved with this. The point is, what's the optimal strategy? The optimal strategy is, as I said, watch the weekly update and then you'll know. And I'm holding this. I'll hopefully hold it for 5 years, but I monitor it every week and then it'll at least be held for the next 12 months. But should tomorrow morning, I don't know, Putin detonate a nuke in Kiev, all bets are off, aren't they? Obviously. So I can't say I'll hold something forever. And we'll come to the processes later, but I just want to show you some of this stuff for now. That's going to 420. It's currently roughly at 310. The highest analyst thinks 420. He's the one who's right, wherever he's working. And that's where we are on that. Amazon, similar story. Barclays, Goldman Sachs, all of them think it's a buy. That's not why I like it. I like it because value, growth, income, cash flow all fit in, and it's been just rocketing ahead. Last year, it fell 54%. What did we do last year, though? Well, last year, if you followed my Telegram and everything else, we had to get out of it. It was like, well, we'll buy it back cheaper. And then we thought we'd buy it back in March. No, wait another month, wait another month, wait another month. And you might say, well, wait a minute, when it rallied up here, you must have thought, oh, you're in, sort of at this time of the year. No, because it was still falling down there. Okay. It was still falling on the monthly. And that was the giveaway that this was a false breakout. So I'll let you into a secret. Weekly charts here. These are weekly charts. That's monthly. MACD, momentum. And if that's falling sharply like it is there, okay, that sort of tells you, shortcuts everything. It's like, stay well clear. Don't buy it. Don't bother looking at the news. Don't bother looking at anything. Just stay well clear. And then we got, at the start of this year, flattening there. And that was it. It was like, yeah, time to get in. Okay, so that's what we think with that. High 220. That means basically 100% return on Amazon. And again, I don't want you to think, oh, you're saying this now in May. No, go look at my YouTube or Telegrams and my weekly updates, and you'll see that I've been saying it since January of this year. I didn't know January of this year was going to be the turnaround. I just reflect what's in what I can see. And this already met our fundamental criteria, which I'll show you: value, growth, income, cash flow. Meta is another one. This V-shaped recovery was sharper than I thought it would be. It was better than I thought it would be. I'd rather have an upside surprise than a downside. I've had some downsides surprises as well. It's not always accurate. But yeah, that's been fantastic. And it's been a really good year coming so far, thanks to those companies. A few others, which I'll show you. And there were a few bad ones, but because we have a stop loss, we got out of those. We ditched them. We don't just sit there and take the pain. Okay. And that's the trick. Some disappointed, which we thought at the start of the year will be really good, but they didn't produce. So we sacked them like employees. We sacked them. So what we should be left with during the course of the year are just really good companies. Okay. All the way across. So that's Meta. It's roughly at 235. This guy thinks it'll go up 50%. The one who thinks it's at the high, and that's the guy who's right. Okay, Nvidia was one which, graphics card maker, which again, big company, lots of buys. That's not why we picked it at all. That's just nice to have. And you can see it's rising. Now, this might be a bit toppy. I'll do a weekly update later on today on YouTube and Telegram, where I'll repeat what I've said before. I think it's approaching, for now, the top. You've pretty much doubled your money. So if you want to take out your original capital and let the other half run, that's fine. If instead you want to be risk averse and get rid of all of it, that's perfectly fine. So that raises the question, well, what do you, when you've got one of these stocks in your portfolio, Alpesh, how do you make decisions? And this is my go-to flow chart for people. So please have a look at this, and I'm going to take you through it. You can take a picture and you can amend your own. This is just a framework. You don't have to follow it, but I'm saying it's a good way of simplifying your life. You draw it, print it out, and not getting confused. And that's really important as a good process, because I've seen people build up their portfolios bit by bit, and then they don't know what they're doing. And good companies end up making losses, and they hold on to them for too long, or they don't know how to get out of ones which they shouldn't have been in the first place, it turns out. Okay. And this flow chart creates, it's your business, your pension, your sons or daughters, ISAs, SIPs, your wife or husband. That's your business, and this is your business process. So isn't it worth the time to do it? Yeah, and simple. Just cheat and copy mine. So this is what I say to people. They ask me, what do I do with my portfolio, Alpesh? I say, well, watch Alpesh's weekly market update on Telegram, usually out on Friday, and it's free, Friday evenings, right? Now, then you ask yourself, is it a quality or very close to quality company? Now, I've even added PayPal in there. And the reason I've done that is, even despite PayPal falling 70, 80%, is big companies sometimes do that. Meta fell 80%. But if fundamentally the cash flow is there, the profitability is there, and all those other things are there, you might then decide, well, yeah, or it's a Microsoft. Yeah, I'm going to keep it. Am I risk averse? Yes. So let's say you become risk averse because you watch my weekly updates and I say to you, ooh, the momentum's going down on Microsoft, things are falling. You might, I might not, but you might say, well, I want to sell 10 to 100% depending on risk appetite. Your risk appetite is different to mine. Okay, it's bound to be, right? For all I know, you've got 3 private jets sitting in the back garden. Your risk appetite is going to be different to mine because I don't have 3 private jets, right? So that's one reason why it'll be different. If you're not risk averse, you hold and you do nothing, right? Equally, if it's not one of those quality or quasi-quality companies like a Microsoft, Apple, Amazon, Alphabet, then you say everything else, it's what I call a performance company. So everything else, performance company, and you ask, have I held it for 12 months? If you have, then I say you sell. Because every 12 months, you sack everybody in your company and you say to all of them, reapply for your job to be in my portfolio and all the other 10,000 candidates who want to be in my portfolio, okay? And if 12 months are up, then you say, well, 12 months aren't up, but has it fallen 25% from the highest it's been since I bought it? In other words, is it underperforming even though 12 months are up? And if it has, then you sell all. And you might say, no, I'm not going to do 25%. I'll do 30%. Or I'll sell half if it drops 15 and half if it drops 30. It's up to you, but you get the idea. Don't say if it drops 1%, I'll sell all of it. And don't say if it drops 100%, I'll sell all of it. The answer is somewhere in between. I've picked 25 just so I know where my risk is, but I can always tweak that for individual stocks. And if neither of those conditions are there, then you just say to yourself, well, am I risk averse? And if you are, then you might sell early, 10 to 100%. And if you're not, then you just wait until one of those conditions applies. It's that simple a process. Take a photo on your camera phone if you wish, and I can come back to it a bit later. Okay, so with NVIDIA, I'm now saying, well, I'm getting a little bit risk averse. I might sell 50% and let the other 50% ride. Or if you're risk loving, you'll say, I'll keep hold of it. And if you're risk averse, you'll say, I'll sell all of it. It's not about what Alpesh is going to do. It's about you being empowered and knowledgeable enough, which is the point of this webinar, to do it yourself and know how to do it. That's why I teach this stuff. Okay, the price currently is 285. The analyst at the high point thinks 355. He's right. And NVIDIA is riding on the AI wave. And the AI wave is not bullshit. It's not like the dot-com bubble. I mean, for some companies, it might be. Some companies are talking nonsense. They're the smaller ones. The big companies, they are making money out of it. I pay OpenAI now $20 a month, and I'd pay them $200 a month. Actually, I'd pay them a lot more if they wanted it, which Microsoft put money into them, and they just created money out of nowhere. Okay, so I can use their AI engines and put all this stock market data in, which is what the article on Business Insider about me was, that somebody's doing this. And I've got a talk at Financial Times coming up next month on how I'm using it. And I think I was the first person on British television to use AI to comment on earnings reports. So I want to be cutting edge on this, and I love it. I just love what's happening as well. JP Morgan I own. They might say, wait a minute, Alpesh, and this is a brilliant question I had this morning from someone. Alpesh, I've made a killing on Microsoft, Apple, Amazon, but it's now a big part of my portfolio. How much is too much of those? And I said, look, in hindsight, you'll probably look back on this year and go, I should have just bought 100% in those 4 stocks. But sensibly, does anybody do that? Not even Warren Buffett. So yeah, I've got a few others, which I know won't do as well as those, like a JP Morgan. So why have I got them? Well, I just feel a little bit uncomfortable only owning 4 tech companies in my entire pension SIP and ISA. Because if something went wrong somewhere, my wife's going to turn around and say, great companies, but what the hell? Only 4 of them? What's wrong with you? Okay. And I don't think that extreme event would happen where they all drop 70% at all. So you might say, well, Alpesh, you need to grow a pair and just buy those and nothing else. So anyway, I've got some others in my portfolio. Okay. That's where we are with JP Morgan. You've worked it out, how to read all that. I've already shown you that. Take a picture again if you wish. I'll just set the questions. Are you concerned about Amazon's negative free cash flow and stock-based? No, I'm not at all. And I'll tell you in summary terms why. Read Jeff Bezos's annual report since 2000. He's always run it like that, and he's never had a problem running it like that. Amazon is hugely profitable, and they manage their cash flows. And they manage talent acquisition. There's just not an issue with them. The first thing I want to look at, how profitable are they? They're seriously profitable, and they've got a bucket load of money, and the world is willing to lend them money. And let me put it this way. Lending money to Amazon is safer than lending it to the American government. Okay? So there we go. Jeffrey, no worries at all. Okay, so that's that one, and that was, whoops, and that was that one. Take a picture of it if you wish. Take a picture of it, take a snapshot. This is what I teach my students as well. Now, before we go into more process of how do fund managers destroy your pension, this is one way. This is a fund manager called Blue Whale. Now, I want you all to do something. If you've got a job and you've got an employment pension, ask HR or whoever, who have you given my money to? Which pension fund manager? And it might be Blue Whale, it might be Scottish Mortgage. Then ask them, how did they perform last year? And I want a breakdown of the stocks they own, because they're obliged to give you that. That was down 27%. You know, an IFA on Twitter had an argument with me that that's fine. It's not fine. It's a pension. If you think that's fine, that somebody put money into a fund, not an individual stock, a fund, so it's supposed to be low volatility, lower drops, which went down 27%, even if they put a small amount of money in there. If you think that's appropriate, that's fine. Just wire your money to my bank account in that case, because clearly you don't care about your money. Okay? And the IFA will try and convince you, no, it's okay. It's all right. Yeah, this stuff happens. Anyway, that's where we are with that one. Funds pick relative to index. This is what funds do. And in case you didn't know, the fund looks at the index they're benchmarking. How much does it own of certain stocks? It might be an Apple, a Microsoft, whatever. And then they say, should we have a bit more or a bit less than the fund? The index, sorry, because they're trying to outperform the index. Now, that makes their job a lot easier to try and outperform the index. Eugene Fama got a Nobel Prize in 2018 for showing that they even mess it up then. And I don't care about beating the index. I need to get an absolute return. I can't go to Starbucks and say, look, can I have that coffee for free until the index is up in absolute terms, because I didn't make any money this year because I'm down 10%, but I outperformed the index. Well, that doesn't show up on my bank account. Absolute positive returns do. So, I mean, fund managers, the retail fund management industry is such a con, and they have so sewn up the pension industry. They take, you work your ass off. Legally, you have to give your money into a pension, and that pension manager will give it to a fund manager who will charge you money, underperform the index. I mean, what a great con scheme that they've got going on. And those fund managers, time and again, don't take my word for it. Eugene Fama, look it up, Nobel Prize 2018 in economics. I'd written about Eugene in 2000, the year 2000, in this book, and said, this research is doing some amazing. He got the Nobel Prize 18 years later. The Nobel Committee obviously hadn't read my book. 18 years later. How do IFAs destroy your money? Well, there's times I've been doing an investigation into this, and it's pretty terrible. So you really need to be educated. Congratulate yourselves for being on this webinar. How do you destroy your pension? Well, name recognition is the biggest thing. That's Scottish Mortgage Investment Trust. Hey, Alpesh, I lost 50% of my money in it, but I'd heard of it, and it keeps coming up. It's a darling of Shares Magazine or whoever. I mean, I like Shares Magazine, by the way. But you know what I'm saying. It's like, oh, it's like Kathy Wood. She's the darling of CNBC because a lazy booker can't be asked getting anybody else on. So let's go to Kathy. She's always available. And she'll come on and go, yeah, my funds are down 50%, but don't worry, we've got another new one. You know, it's, or Neil Woodford, hey, we'll keep promoting. So anyway, watch out for name recognition, all right, on that. And the average investor gets, according to JP Morgan, 8.7%. That's the US average investor. The UK one gets about half as much because the UK market tends to do half as well. The S&P did 16.6%. That's the S&P per annum over the last 10 years. You might say, oh, it was a particularly good 10-year period. Yes, it was. Yes, it was. I grant you that. Okay, but my point is you're doing half as well as an index. So let's say you halve all these numbers. You're still doing half as well as the index. So why are you messing it up? Why are you, as private investors, messing it up? And it's part of my job to make sure you don't. Well, one of the reasons you're messing it up is you're trading your investments. You're dipping in and out. You're forgetting what's an investment, what's trading, which is why we have our flowchart to stop you doing that and enforce the discipline on you. And I've given you the flowchart. And the other reason is you're picking from a narrow gene pool. You will tend to do name recognition or in the case of British investors, oh, I'm British, I've got a SIP and ISA, therefore I'll only invest in British companies. Well, that's pretty stupid because if you only invest in British companies, and then you're pretty much excluding for your SIP and ISA, everything else. And occasionally at this point, somebody goes, what about currency risk? And I say, So the 1,000% that Microsoft goes up, you're worried about the 1% in currency risk you're facing? Oh no, but it's a lot more currency risk than that. Really? Because when I was holding dollar assets and we came out of Brexit, I made a windfall because I owned dollars. And when Liz Truss became prime minister, I made another bloody windfall because I owned dollars. So where's the currency risk? It's in holding sterling. That's your currency risk right there. I'd rather pick 10,000 from 10,000 companies than be racist in my stock picking and say I'm only going to pick British companies or nationalist. No, that's how you want to pick it. Okay. Now I do appreciate, I love all this data. I love this. What you see on screen, I love it. If I could, I would go to bed with this sitting, on the bedside with me because I love it. But that's not for you to love. Okay. This is going to cause paralysis by analysis. I mean, so let me simplify things for you. And these are the problems private investors have. They pick stocks like a hoarding bag. Oh, I heard about this, heard about that, heard about. They don't have a timeline, so I've given you the flow chart. And they don't have a process. So I'll buy that. Oh, somebody told me about this. Somebody told me about that. Now, if you want to have a basket of stocks, which are high risk, just for fun, just, my mate told me, then create a separate tab on an Excel spreadsheet or Google Sheets. Just create a separate one saying for fun or for long term. But don't put it in your bloody pension SIP and ISA. Because it's really bad for you. Equally, people don't know when to let go. That's why I said 12 months, everybody gets sacked and they've got to reapply for their jobs, with the exception of the quality stocks, Apple, Amazon, Alphabet. Okay, what are the factors we're going to look at? These are the factors for my due diligence checklist. Now, it's 40% realistic. Well, actually, US, not UK. It is not realistic for UK. For UK, I target half of that. How have I done? I'll tell you that, how we've done since 2004, because it's been publicly audited real time, not historically, but real time as we went along. So it's not like we could say, oh, let's just play with the historic data before we send it. No, it was done in advance. So each year they keep looking at it and say, right, you've given us the names in January. Now we're going to audit it at the end of the year. Oh, that's what you didn't, you couldn't change things. You couldn't go back and change things. So I'll tell you that for the UK. And for the US tends to, as an index anyway, do twice as well as the UK. So my US returns are twice as good as UK, and that's not because of me. It's just Americans do twice as well. I mean, you can see the S&P does generally over the long term at least twice as well as the UK, actually significantly more, but okay, we'll just assume twice as well. And these are the factors you've got to look at. We know from the academic research, we know from and the academic research is in there as well. It's free to download. Okay, Palgrave Macmillan are the publishers. I mean, you don't have to download it for free. You can pay £35 and buy it if you wish. But valuation is important to future stock price movements, but it's not the only thing, and it's not guaranteed. And what do you want to look at? Well, price earnings growth are fine, but don't obsess over this. Make sure you look at something to do with valuation, whether it's price to book, which is Warren Buffett's favorite, or discount cash flow, which actually is Warren Buffett's favorite, but he doesn't specify it that way. If you listen to him, it is DCF. I don't think Warren Buffett's ever mentioned price earnings ratios. And if you can find him mentioning it somewhere, let me know. So, and there's a good reason why he doesn't. PE ratios are something which is popular with the public, but it's not what he uses. And you might think, oh shit, I never knew that. No, as you might know, he uses price to book ratios. He's really cautious, and that's good, which is why his job's so easy. There was an interview he once did, and he was sitting next to Bill Gates, and they said, let's have a look at your diary, you must be really busy. And he looked at the diary, he had nothing in his diary for the next 3 months except one meeting with Bill Gates. And he said, how come? He goes, well, I just spend my day reading. He goes, yeah, but people want to meet you. He goes, yeah, I'm sure they do. I spend my day reading. There's nothing much to do. When you get this business right, I'm not kidding, I will get so many emails from people on WhatsApp saying, oh, I know you must be busy. And I'm going to let you into a secret. I'm not. Most days I'm not. I mean, I was busy yesterday because I went to a friend's investiture as a chancellor of a university. It has nothing to do with investing. Because you're not busy. It's done. The process is there. It's stupid. It's just not fair. It's not right. My mum was an NHS nurse. That was busy. Anyway, so valuations, PE ratios, growth we know is important, but not the only thing. And we know from the research and statistical analysis, growth is not as important as valuation. The beauty of ChatGPT is it can actually tell you the research which proves this. See, in the past, you'd have to Google it. And Google would give you a whole lot of bullshit adverts at the top saying, which is the most important factor, growth or valuation? And you'll get a whole lot of crap. As a search engine, it is useless now. Okay, pretty much, I think it's useless. Okay, ChatGPT will actually tell you what's more important for future price growth or valuation, and what's the academic literature behind it, and it'll give you the results. And we've checked it. Like I said, we have ChatGPT 4 Plus with Wolfram Alpha access and internet access, so we can double check it. I mean, we also know our stuff, so when it gives an answer, we can go, geez, that's right. So anyway, you're now able to verify, which is important in the internet age, verify what somebody's telling you a lot quicker than you are, but you need the skills to know how to do it. Income, I'd say, is about 10% important. So in these factors, I say valuation is about 40% weighting, growth about 20%, income about 10%, and then the other things, the remainder. Momentum is important. We've got the academic research. You can look it up yourself now. Before I'd say Google it, soon people are going to say ChatGPT it. Okay, it's going to be a phrase. You heard it here first, ChatGPT it. And I have to say it about 10 times a day to my wife and my staff, because they keep saying, oh, how does this read? We're thinking of sending this for this or that. And I go, ChatGPT it. Don't ask me. Before it used to be Google it. Okay, momentum, all right, statistics. So we look at all of these things and then we narrow it down. And what we're doing, so this is the starting point. There's the data. Okay, we put it in, value, growth, income. So I create a little algorithm which weighs for a stock its value based on PE, price earnings growth, its growth, its sales growth year on year, earnings growth year on year, cash flow growth year on year, its dividend yields, its CROCI, which I'll come to in a second, which is from Goldman Sachs, its momentum, Sortino and Alpha, and I'll come to what those mean as well. And then we weighed it and gave it a score, and we still look at the other things. And then what we do to make my life even easier, and I suggest this is a process you use, is marking green anything which matches my minimum criteria. And if it doesn't give green across all the first 4 columns, then it's not good enough to be in my portfolio, because I've got to sift through 10,000 CVs. So to get to the top 100, out of which I'll then pick the top 20 stocks, and I'll come into that and how we do it and what you should do as well, so you can copy it. We have to first start on a spreadsheet, which is what everybody else does when they're looking at CVs. Okay, and that's the data that can go in. There's a lot of data. You can get data to screen these kind of things. Yahoo Finance, I think, offers it for free. Google Finance, I think, has one as well. I mean, that's assuming unless you're paying for data yourself, okay? But let's go into a bit more deep dive on all of this, shall we? So the strategy, like I said, is value, growth, income, cash flow, outperformance, volatility. Let's talk a bit more about that. And then the tie break or tactics, and these tie breaks, these are not so important as to make a difference from what we can tell from our research, but you have to tie break on something. You've got 100 stocks. How are you going to tie break which one's going to your top 20? So sometimes I'll say, oh, Warren Buffett owns it, so that'll be a guru tie break. Or the analysts think it's got a really high price target. That'll be analyst price break. Now, the mistake most private investors make is they do tactics, they don't do strategy. Okay, so what they'll do is they'll say, oh, that one's in the right sector or in the right geography or low volatility, so I'll just buy it, or it's in the news. Well, no. If you haven't ticked value, growth, income, cash flow, outperformance, volatility, then you shouldn't be looking at tactics to begin with. So for us, those are just tie breaks there. We give them low importance. Private investors give them high importance. Okay, so let's have a look at that. That breaks down like this. Okay, that's what it looks like when you then filter across. And I'll give you more stocks. So we put all this data in and we asked ChatGPT from the Dow, the best Dow 30 stocks. If it was a Nobel Prize winner, Eugene Fama, so we said, and it knows the work of Eugene Fama and Warren Buffett. It knows the work of Warren Buffett. And using the most important academic literature, and we asked it, what's the most important investment literature? So we knew it knew. Which stocks would you like? And so this was the basis of my of the article on Business Insider of me. Okay, and these are the companies it came up with. Now, what was interesting here is I own 2 of them already, Visa and Microsoft, but it also came up with Merck, Procter & Gamble, and Caterpillar, and it gave good reasons. So I thought to myself, okay, let's have another look at these. And I thought, actually, they're fine. They actually do meet all our criteria. We just couldn't buy everything, and that's why we didn't buy them. But it was great that it had these. And I also told it the macroeconomic environment of rising rates, because it can absorb all this information and spew it out a lot quicker. Now imagine, I want to tell you something. You know, when people go, oh, what jobs are going to go? Oh, is it going to be low skilled, high skilled? What? And before I had to put that in, I had to tell an assistant this. And imagine how well trained my assistant has to be to know the works of Eugene Fama, Warren Buffett, academia, and what rising interest rates means. They'd have to be pretty stonking good, and they'd have to be paid about 6 figures, and they've probably been to a really good university, and they're looking to leave me to join Goldman Sachs or whatever, aren't they? Now, it's not that I can sack that person. Now, I can teach that. You're not going to believe this. And I kid you not. I've got somebody in India, in Punjab. So I'm not talking India as in Bangalore, which is where the smart ones are. In the Punjab, in Amritsar, who I can teach this to, who has no financial education. Okay? She's going to keep her job. Because otherwise, she might not have kept her job so much. And what about the person who was doing the other stuff? Well, no, they'll probably still keep their job, but they'll be able to do higher order stuff. They won't need to do this stuff. I mean, after all, if they were getting paid that much money before, they're pretty good. They're going to be doing stuff that I really want them to be doing, not the menial stuff. It's a bit like when I go home and my wife says, oh, can you empty the dishwasher? And I say, well, surely the butler or the footman would have done that by now, but, no. And I have to do it. And I think, well, I shouldn't really have to do that. So now, same in the companies, the people who really shouldn't have to do the rubbish stuff won't have to do it. Anyway, that's an insight into it. Those are the stocks there. I'm going to come back to more stocks. And by the way, for those of you who are interested, that's the academic literature that it went through. And I was impressed because even I wouldn't be right up to speed on financial econometrics. And I've got a master's degree in economics. I mean, if you told me sit down and put all of these factors in for every single Dow stock and here's the data, I'd be like, oh God, I need to outsource this. Okay, so there's a whole bunch of stuff there. Simon says, what's my view on Palantir? You say emerging AI, it's been around for a while. My wife's worked with them when they were raising a shed load of capital. And I did a post on them. At the moment, they're not going to go bust, famous last words. They're not going to go bust. They're massive, particularly in cybersecurity. But yeah, Microsoft's an AI company. I need you to know that, okay? And Alphabet is an AI company, and Meta is going to pivot again. It's probably going to change its name from Meta to AI, okay? But Metaverse BS, that Zuckerberg, because he's a geek, never have the guy got lucky with Facebook. I mean, but you saw even from the movie that there's something weird about him. And this metaverse thing where all he wanted to do is wear goggles and just sit in his room. What a load of waste of money. No wonder it dropped 70-80%. And then he realized, maybe I should start doing something in AI. Given that I've got $1 trillion in the bank, I can do anything. Guess what? Yeah, you bloody well should, mate. Elon Musk with $1 trillion in the bank said, let me launch rockets and satellites. Okay, so that's the thing, the unlimited potential. So yeah, Palantir, people ask me on TikTok a lot about Palantir. Obviously, something's happened on social media where a lot of people have got screwed with the falling price. Value income graph, that's what we're going to look at. Monitor infrequently. Every 2 weeks is fine because I don't want you trading your investments. 12-month holding, 15 stocks roughly. 40% is my target. If I don't think it can realistically achieve that, and you saw from the analysts or from the price charts where you can project forward, then I'm not going to get into it. It doesn't mean they will achieve it. Some will do better, and I'll show you examples. Some will do worse. Okay, and 25% if it drops, but you can change that to 30%. Then I'd want to exit. And you got my flow charts. One strategy, many tactics, 20 to 40 investments. Why 20 to 40? Well, because if you only have one stock, you've got a lot of company-specific risk. Once you get past about 20 to 40, you're covered. You've removed company-specific risk and you're left with market risk. If you don't want market risk, then don't invest in stocks, okay? So what does it look like when it looks great? When it looks bad, I'll tell you what the hypothetical bad situation is, and it's never happened. Imagine I buy 20 stocks and put equal money in each of them, and on the day I buy them, they drop 25%, every one of them. Then each one would be 25 stocks, 1/25th, and a 25% drop, I'd lose about 1%. Okay, per stock. So the most, if every single one of them dropped, would be 25%. My portfolio would be 25% down. That's never happened. The statistical likelihood of that happening, pretty bloody low. Okay, but what I'm saying is, if you compare that to a normal fund, actually a normal fund's top holdings have the same impact. If they drop, you're going to lose 1%, 1.5% of your overall portfolio. So our risk isn't any greater than a normal fund, except we don't spread it across 100 stocks where, they've bought 50% of their money's in the top 10% of stocks, their top 10 holdings rather, and the rest is in, a long tail of thousands of stocks. We just put it into 20 stocks, easy to manage and monitor. So so that's worst case. Best case, this is what happens. Is it typical? No. Will it happen again? I don't know. I can't guarantee it. I hope so. I hope it happens every minute of every day, but can't guarantee it. But the important lesson I want to teach you about this is this. Some years you do better, some years you do worse, and it should iron out. So why did you, Alpesh, just not put everything in Crocs? That's not even a tech company. They make those ugly shoes. Well, I didn't know it was going to go up 208%. The whole point is, after all this analysis, I'm not also trying to predict how much they'll go up. I don't know. Okay, I'm hoping they go up 208%, but if I knew that, I would have put everything in it. Imagine somebody said to me, oh, Alpesh, you're guaranteed to make 208% in 12 months in Crocs. If they guaranteed it, and the guarantee, let's just assume the guarantee was given by God, okay, then of course I would have just bought that one thing and put all my money in it and borrowed a ton of money and put it in there. But I didn't know that. And that's an important point I want to make to you about what we're doing. That's why we have more than one stock. Generac, similarly, Costamer, Camtech, that's the ideal scenario. And some of the ones which go up so much in your portfolio will make up for the ones which don't and which have to be sold. So that on average, some years you do better, you get your 54s, and in other years you get your 10s, and that averages out. That's what it's about. So what does this look like? Imagine you're planning to invest over 10 years. I'll mention some other stocks in a second. And with my help, let's say instead of 16.6%, the index, you do a bit better than the index, and let's say you get 20. Some years more, some years less. And you got 100K in your 401k, SIP, ISA, whatever. And you plan to add 1.5K each month. Well, you'll have $1 million by the end of 10 years. That's the maths. My job for my family is to convert every 100K into $1 million. Not over 10 years, because they'd think I was pretty rubbish if I did it over 10. But let's just assume it was 10 years. And that's what it looks like. Some years you do better, some years you do worse. So why don't people do this? Compounding. Why don't people do it? Because guess what? For the first 4 years, it looks like you've barely got more than you've invested. And my wife says the same. When I show her this, she goes, yeah, but if we do stuff like this, does that mean we can't have holidays? That's the only thing she ever asks. And I say, no. What? No. It's the only thing she's concerned about. She's not dim. She was ex-Deutsche Bank, but she always asks that. I said, no. She goes, yeah, but it just looks like we're going to be saving and not spending. I go, well, yeah, all right. So I tend not to show her this too much. And the whole point is that in year 9 and 10, and most people don't like delayed gratification, in years 9 and 10, you're making 100,000 or 200,000 doing nothing. But who wants that delayed gratification? Because for the first 4 years, you're working hard. You're hardly getting anything. Now, let's make the sums even smaller. So this is the case of my son, who's 5, his junior ISA. And we max out his allowance, and this is what his return will look like. So for the first, and he's 5, okay, it hardly looks like he's got more than the money we've put in. And my wife would look at it and she'd go, yeah, but you've put that in. He's only got a bit more than that. I go, yeah, all right. But the whole point is, by the time he's at university, and I'm living in Bali, they'll be fine here in London, because each year they'll be getting 100,000 just from the ISA. That's what will happen. They'll get 100,000 just from the ISA each year, because that's the growth. And that's the point of it. And nobody ever thinks that far ahead. But from Bali, I'll message them and say, look, I told you I was right all along. I've put this all in my books. Just so you know, so this is not new, and in my Financial Times columns and all the rest of it. So, you know, all of this research is not just based on what I woke up one morning and decided to do. It's actually based on 23 years worth of books that's been published. And I've been telling anybody who'll listen, whether it's, you know, that's my team outside Number 10. It's me on BBC, where I'll often talk about it. And I even got in front of the Duke and Duchess of Cambridge on it. Now, managing risk. I've written about it in the FT as well. So I want you to know where the provenance of all of this, as it were. Reminder of when to sell. 12 months and reevaluate, drops 25%. You can change those numbers if you wish. Okay, I'm just saying you at least need a starting point framework, don't you, of good practice. And the problem at the moment, this is I took from one of my students' investment funds. So I said, show me what you're actually invested in. And this is what he had invested in. And it was through Vitality, and it was, I think, 91 were the fund managers. And they actually said on slide 58 of their presentation, investment, £10,000. If you cash in after 5 years, recommended holding period, that's your total cost will be £1,000. So I said to my student, I said, you know, you're paying 10% over 5 years. He goes, no, it can't be. Because in the small print, it says 0.1%. I So I don't care what your small print says. They've told you on slide 58, you're paying 10%, 10,000 pound investment. That's theirs. That's the screenshot. So just be careful. Please ask for those PDFs from whoever your pension's invested with through your employer. Please ask for those. And I genuinely believe you can be better than overpaid fund managers like that numpty. I mean, he got away with it. He got away with it because Hargreaves Lansdown said, let's make him into Cathy Wood before Cathy Wood existed and push him out there, just put him out there. Now, Cathy Wood's lost a lot of money for a lot of people. Woodford will still have fans because you'll always get psychopaths who will support other psychopaths. We knew in 2004 when on a competition that the Financial Times ran over a 12-month period, he basically did a little bit better than the editor's cat, which you can see over here. Okay, Jasper the cat. He was basically tied with the cat. All right. And guess what? They went on to give him £9 billion. That's how the City of London works. People think the City of London is an efficient allocator of capital. No, it isn't. If it was an efficient allocator of capital, it would have given it to me, wouldn't it? Obviously. Well, it wouldn't have given it to him, would it? Okay. No, it's media. It's all the biases that we have in life. This was an article over 10 years ago. This underperformance by these active fund managers is well known. That's why I want you to do it. Then you've got the wealth managers. I mean, there's been enough articles about in the Sunday Times about St. James's Place, haven't there? And all of this. So I want you to be educated so you've got the right questions to ask and say, well, wait a minute, why have you put my money in this? I don't want it in that. I want it in these companies because I have looked at value, growth, income, cash flow, and all of those things, and that's where I want it. Okay. I'm going to stop that poll. I realize I didn't ask other questions. So 63% of you think the FTSE will be high by the end of the year. Let's try it with the Dow. I'm going to publish that poll. Is there much benefit investing in funds like Vanguard, Life Strategy over cheaper market? No, there isn't. Do the cheaper ETF. Simple answer. Speaking of Elon, opinions on commercial spaceflight companies, Virgin Galactic. Well, Virgin Galactic's gone bankrupt, hasn't it? I might have missed that. Didn't it go into chapter 11? And then, so Virgin Galactic is an interesting story because this, and I can't ever pronounce his name, Chepanataya. Anyway, he raised a whole load of money for SPACs and went to Richard Branson and said, listen, I can raise you $1 billion. And Branson went, whoo, okay. And they floated it, took the money, and then they couldn't launch the satellites. Great. So, and what pissed me off about that, when they did the launch from Cornwall, it was British satellites that they couldn't launch. Luckily, Britain had plan B, which was to have the Indians launch 57 satellites, which they did the subsequent week at a lower cost. So thankfully, the British company got their satellites up there. But if it had relied only on Virgin, we'd be a laughing stock. That's the gurus. So this is a tie break. If I then look at the gurus, like Soros, Buffett, this is what they own and what percentage of their holdings, their top 10 holdings by percentage. So Apple, he's got 41% of. Soros has got whatever that company is. Microsoft, in the case of obviously Bill Gates, and then Berkshire Hathaway's got, and so on and so forth. Now, this doesn't make me want to buy these stocks at all. I'm saying it's a tie break. Looking at gurus is a tie break. Similarly, looking at hedge fund reports, and this is old, so don't look at this now. This is for example, from a previous time. So AbbVie's not in my portfolio, and I don't think it's come up in any of our scans or on AI, isn't on there, but we'll look at what other hedge funds are doing. We'll also, as a tactic and a tie break, look at discount cash flow. This is not up to date. Okay, this is from last year, so it's just as an example. So discount cash flow is another thing. As a tie break, we might also look at which ones have low volatility, like McKesson last year, and we'll double leverage on it. You can get 2 times leverage ETFs. High risk, don't do it. Don't do it. It's for me to do, not for you. Okay, sounds patronizing. I apologize, but 2 times leverage on spread bets, CFDs, or ETFs is high risk. Don't you do it? I'll do it. But we only do it when we've got this. This is from a website called Wolfram Alpha, which is now also connected to ChatGPT, by the way. Wolfram Alpha gives us this data. We use tools which are out there. We can't afford to have our team program this stuff. We're not that big. We can't afford that kind of money that we'd have to spend on getting engineers. I mean, I can't just willy-nilly drop £500,000 on somebody creating some specialist thing. We're not that big that we can just keep, there's £500,000 here, £500,000 there, £500,000. Before you know it, we've got nothing left. Okay, so we use what's already out there and we use it smartly, which is actually, there's an Indian word for it, jugaad. you sort of innovate from what's just around you, and it actually works well. And it's one of the reasons why those Indian satellites and the rover to Mars was 1/10 of the cost of. Basically, it costs less for India to send a rover to Mars than it did to make the movie about the rover being sent to Mars, which Hollywood made, which cost 10 times more. Hollywood literally could have sent 10 rovers to Mars and filmed them, and obviously the film. Anyway, so that's where we are on that one. We'll look at other things. Okay, investing. We'll look at analysts and say tiebreaker. So this often comes up in my weekly updates. We'll look to see, there's some interesting ones on the tiebreakers where the analysts just think there's over 40% return per share. Can you see that up there? And that's the one we do on that one. And we'll also look to see which has the best cash flows. So this is from Goldman Sachs, and it was invented by Deutsche Bank, but Goldman Sachs Wealth Management used this. And it's phenomenal because, and it blew me away. It's why I stole the slide. And as a hedge fund manager, get invited to these lunches and all these nice little things. And this was one which actually was worth attending. And Goldman's were pitching for our capital, give it to their people to manage, and we'd just sit back and take the fees for letting Goldman's manage it. But anyway, I decided to steal the slide and steal the intellectual property. So there's the formula: cash return on capital invested. Sort of a Robin Hood, I'd like to say. I stole it from the rich, and I'm giving it to everybody else through this webinar and through my books and education. And you can see there, if you're in the top quartile by cash return on capital invested, then you're going to get a 30% per annum return in the basket of stocks that you have. Not every stock and not every year, but as an average. So we try and find companies which are in that top quartile, and we mark those in green. But we still want them to meet other criteria as well. And you can see actually there's a whole bunch of companies here which coincidentally actually meet all of those, except the volatility is a bit high, which I'm not happy about. And this is alphabetical: Hilton Grand Vacations, HireQuest, and HMS Networks. Okay. I don't know them, but they happen to meet the criteria on cash flow and the other criteria. Can I tell you at the end something in the last 10 minutes? You don't have to stay with this. That spun out of my hedge fund that we're doing, and we want to get venture capital investment for, and hopefully also get a flotation for in due course. In the last 10 minutes. So say yes if you do, and if you don't, leave, or say no, but say yes if you want me to tell you about that in the last 10 minutes. So that's the holy grail. Okay, we put that data in. Now we put into AI as well, just to double check the results. I just think it's too much fun not to. And I'm going to start adding that to the weekly updates. I'm going to start adding, okay, well, which are the AI stocks for the next 12? Because we actually ask it for the next 12 months. We don't say which are the best ones now, because what does that mean? It could be for the next 5 minutes, for the next 12 months. And here's the data. And so let's see what happens with that. And we'll give mine and AI's and Warren Buffett's as well. And that's the way. So what I want you to do is remember this. Look at value, growth, income. You might not get croaky data, so look for cash flow data. Momentum, that's easy. Sortino and Alpha. Sortino is average return versus risk of missing it. And it's the most popular question we're asked in the hedge fund industry. Okay. And Alpha. Now, Dylan, are you concerned that tech companies are now heavily overvalued on a lot of metrics? They've been heavily overvalued on those metrics for ages. If you take something like, let's take a metric. Let's take price to book value. And if you look at Microsoft and its ownership of ChatGPT and the 10% it owns, or whatever, the billions it's put in, what book value are you saying? Okay, so the metrics not reliable. There's very few companies where the metrics are not reliable. Profits are accurate. I can look at the profits, and you're saying, okay, let's look at price earnings then, Alpesh. That's reliable. Yeah, you're absolutely right. Share price, it's a number which is true. Earnings, that's a number which is true. And that multiple is too high, you'll say. And I'll say, yeah, but the stock market doesn't move on historic price earnings. It moves on forecast. So it's forecasting earnings. And today's share price, compared to the forecasted earnings, is where it keeps getting it wrong for the company. Similarly, take discount cash flow for Microsoft, okay, or Apple or Amazon, and you'll say it's overvalued. Yeah, because you're forecasting a certain cash flow. But what if that cash flow is higher? What if those earnings are higher? That's what's implied in the valuations. And what I'm saying is they're higher than what those earnings are higher than what those analysts are saying. I'm going to be higher. And you're saying, no, they're not. The analysts are correct. Those earnings, which are, you know, growth at 5% per annum is right. I'll say, I don't think it is. I don't think it is, because there are certain companies, a few of them, who are getting these strong profits, have $1 trillion in the bank, growing exponentially, and then coming up with AI out of nowhere and selling that stuff and making even more money, more than my imagination or an analyst's imagination allows for. So essentially, that's what I'm saying. So what I'm saying is, it's not overvalued when you consider that they've got the $1 trillion in the bank, bring the people in, and then they got this cash flow to come in, which we don't even know. They don't even know how much it's going to be. So I think we're being cautious with them. So I'm not worried, basically. Harry, no, it's slightly different to that. This is more involved and detailed than that. Is there much benefit investing in? Oh, no, I've answered that. So this is another way of saying the diversification issue. By the way, when I say anybody can learn to invest, I can teach everyone, this was I really want to inspire you to be your own fund manager. At the age of 21, Naomi left university. She did English literature at UCL, and she worked for me for 2 years as my assistant. Whenever she launches a new fund, she files with the SEC, and she'll mention her career started first 2 years with my firm. And then she went to Newton after my firm, and then now she's at Polar Capital. She now manages £10 billion. Now, like any man, I'm going to take the credit for a woman's success. But on a serious note, my point is, English language or English literature degree, assistant, and they're managing 10 billion? Yes. And she's good. She's good. She's good. You know, well, she better be. I've taught her stuff. Oh, it says there, English literature. Okay. English literature. So it's not financial background. Anybody can learn. Anybody can learn. Just like anybody can learn how to drive a car. Okay. Buffett and Terry Smith seem to rely on ROCE. Does it add value to your screening process? Yeah, so return on capital employed is similar to cash return on capital invested. So ROCE and CROCI are similar. I think Buffett does use that. I think he likes price to book and discount cash flow a lot more, but I might be wrong. I mean, he'll have his own weighing system. But yeah, there's a lot of overlap between what he does and what I do. I think Terry Smith got absolutely hammered last year, didn't he? Wasn't he down about 50%, whereas Buffett wasn't? So I think Smith had just got a bit from the Bahamas, a little bit complacent, and his fund managers just didn't sell. You see, the problem is you need to be nimble like last year. Otherwise, you're going to keep getting slapped around the face whilst the market drops 50%, which is what I think happened to him. How much was his fund down last year, by the way? So I think the problem with some of the fund managers who are good, Smith at least looks at everything and looks at similar things to me, is then they handcuff themselves to, oh no, well, we can't. He's not going to put an order in and say, right, we need to sell 10 billion of Microsoft. You can put an order in and say, yeah, I need to sell £10,000 worth of Microsoft, because you don't mind, you don't get scared by doing that. He's not going to do that because he's going to be scared. That's too big an order to put into the market. So they get sunk. We get asked this a lot, and we thought, you know what, why don't we spin something out of the fund where we give all of this data forever, no subscriptions, and also teach people how to do it? Why not just educate them and on how to do it? Why not give them all of this as well? And then we realized, actually, that'd be a global thing. You could actually give them one-to-one calls. Don't charge a subscription. I have this philosophy. I don't want to charge subscriptions because I don't like subscriptions. Everybody hates subscriptions. I think you should know where you stand. You pay once and that's it. It's yours for life. I just think it's like that. A bit like buying a car or a house rather than a subscription, which is rental. You're basically renting something. You don't own it. I thought, well, actually, would that be a business worth doing? Would that be something, if you spun it out of the fund and then we got venture capital investment for it, could we get that valued at about 30 million? Could we IPO that? Could it be global? Yes, because you could get people from around the world doing it. Can we get the returns? Can we show people that they can do it? And then once we started doing that, we said, well, wait a minute, what's the gap we're filling? Is there a gap? And this is important for you guys to know. The problem with IFAs is they don't hit anything. These are the things you want. They don't hit anything. You guys hit most of the boxes. You tick most of the boxes. Robo-advisors, they miss a load of boxes. Fund managers, they're pretty bad. They're even robo-advisors are better, which is why robo-advisors became so much better. But they became better because they could just tick one more box. That was it. Okay. You guys actually tick a lot of boxes. You already tick a lot of boxes, which is why, again, I want people to be empowered to do it themselves. So we try to fill those gaps. And I think we succeeded in filling those gaps by saying, well, actually, what's the bit that the DIY investor is actually missing? Process, research, lifetime handholding, the research reports that they might want. They still want all of that. Well, yeah, because they're not getting it from the fund managers. God knows, like I said, Nobel Prize in economics went to fame for proving fund managers are rubbish. So the idea originally had evolved over a number of years from, well, why not use algorithms and proprietary indicator scores and then add in extra information and then filter according to that. By the way, there's something else I want to show you, which is not the NASDAQ, not the FTSE. Actually, I'll show you the FTSE 250. By the way, people say, well, why don't you just invest in risky FTSE 250 stocks? Well, the reason is, look at that. I mean, how many actually cross? That one doesn't meet. We need greens across all five. Has that got greens across all five? Yeah, you've got Me Group. I don't know what Me Group does. Volatility 22, I can live with that. That's probably just about the only one in small caps. No, there's another one here. Record PLC. Does anybody know what Record PLC does? I don't. Not that it matters that I don't, but I'm just saying in case you do. But there's very few which tick the boxes. So that's it. Out of the FTSE 250, there's only two. You might want to make a note of those and do them later. By the way, we also look at what do the top analysts hold. And if any, by top analysts, I mean any who are getting more than average return, 27% per rating, would result in 72% in return. So outsized returns, what do they hold? Now, we're not buying it because they hold it. It's still got to meet our criteria, but it's good to know. And similarly with any hedge fund managers, if they do more than 30% per annum, we want to know what do they hold, just in case we're missing something and we cross-check it, just like we do with AI. But it's not, we haven't bought it because they've bought it. The other thing I want you to know, this is from Goldman Sachs Asset Management. I think it's helpful. Now, I think I've got 25 years to retirement. But yeah, just tactically, how much you put into cash rather than fixed income and how much you put in equities depends on how close you are to retirement. So just make a note of that because I think it's important. Those I've given you. I wanted to show you something else. Oh, the ETFs. Oh, they're over here. Right. So exchange traded funds, there's 5,000 of them. And they have these lovely, sexy names as well. Sustainable Global Corporate Bond Multi-Factor. Actually, might I suggest the things you want to look for are these: 1 month performance, 3 months, 6 month volatility, Sortino. Ideally alpha as well. And then the numbers get reduced. Now you can put the ticker, put it into the website. It's always Fund Logic or FT or whatever it is, Granite Share. You can see the names, HSBC. They'll give you a great reason why Indonesia is fantastic. Actually, it's not been doing too bad. It was up 9%. Volatility is only 12%. Key thing here with the exchange traded funds is make sure the volatility is below about 13%. Because otherwise, you've got Microsoft's volatility is 13%, 12, 13%. So why do you have a fund? Why do you have a track? Because you want lower volatility. With lower volatility goes lower returns. But hey, if I said, let's just pick a basket of ETFs, and I wouldn't, say you pick 26 and you got 11% in the last 6 months, and let's say in the next 12 months, 6 months, you get another 11%, you'd be happy, wouldn't you? So that's the process I'd suggest looking at ETFs, is to do it that way. Okay, that's what I wanted to show you there. Anyway, this all got perfected from when I was at university. Won competition, the FT, who then said, do you want to write a book? That raised a profile. I raised a fund. And then I thought, I really want to spin something out which is more software-based, because that's where the stupid multiples are, as somebody else said earlier. It's where the crazy multiples are. And this was the ideal of our project. This is how we started the project on this. And then started, when I was on TV, I'd say, look, these are the stocks we like. I thought, you know what, make this all available, especially because the reviews from people about my work had been phenomenal. And now you've got technology like WhatsApp, Telegram, Zoom, Google Meet, so you can actually have one-to-one calls. I even do monthly meetups as well. And I've actually got one coming up on the 26th at the House of Lords for people who want to come along. And then we got some great reviews, and we started doing video reviews because we said people are not going to believe just quotes. They're going to see videos. They need to see videos. So we did that, and thanks to all of this. So if you want all of this done for you, and you want the education, and you want the data, and you want the hand-holding, you still pick the stocks, but we vet everything for you and give you the data, and you want to be educated. I mean, most people don't do this. They don't go through all of this that we give them for the software and the education and sort of explain what Croquis is and understanding how funds are. They don't do any of that. They say, you know what, Alpesh, I want my calls with you, and I want this database. So we give them the database for life. and it's updated each month. We actually even give them a further filtered version each month. And we give them the education, but they don't bother really looking at this, most of them. So if you'd like it concierged, as it were, that's a good word, and want all of this, then we can do that as well. Now, what our plan is to eventually get venture capital investment into this and make it global, and then hopefully float it, because it's a multi-trillion-dollar industry, is the asset management industry, is the fund management, retail fund management industry. And the best way to approach the retail fund management industry, I believe, is having the retail client learning how to do it themselves, showing them, giving them the data, checking their homework and saying, yeah, those ones fit with the profile you've said, it would make sense for you to buy them, as opposed to somebody doing it for them, or just saying, oh, no, I'll advise you what to do. You just leave it to me, or discretionary, just managing, oh, don't bother me. I'll lose your money for you for 5 years. No, they should be the ones on top of it. It's still going to be a niche. There'll still be people who say, no, I don't want to be on top. I'll just keep my money in a bank account instead. So if you want to do that, what we've done is we've launched that as a separate standalone tech company and now with the AI embedded in as well, no extra charge for doing all that extra work. Our ambition is to get about 250 people through it in batches of 10, and they're in it for life, and then get venture capital investment for it and go global with it, basically. And hopefully in 10 years or 5 years, who knows, IPO it and it becomes a billion-dollar company. Those are some of the things that we thought people would want. And if we've missed anything, I'd like to know, but I think it's pretty much all in there. Everything from the analyst reports, though people don't read that. They really just have the calls with me and the database. That's what they really want. We discovered. We thought they'd be interested in the education, but they're really not. And the daily updates, we have a private Telegram channel for them and show them what I'm buying and selling and what I'm holding and what I'm not, and so on. And that was it. And we thought, well, if we improve by 20% on a 500K ISA for somebody, they've made an extra 100K. That's big numbers. Okay. But that's just 1 year. They've got this for life. We said, even if they just did a 20% improvement over 10 years, they've made 100K. Over 10 years, they made 100K. And the push came from wanting to be not just doing the asset management business just for institutions and all the rest of it, but actually be in the software and the tech business instead. So that's where you go if you want to do that. I'm going to go through the presentation and then answer any questions whilst you all consider all of that as well. But I just wanted you to know that. And if there's any questions I've missed, please let me know. If there's anything I've missed at all that I haven't been clear on, or you haven't understood and that you want me to cover again, or you missed, let me know. But I hope people will sign up for that as well. As I said, my ambition is to get to 250 people, and they've got it for life, and then take it global. And we've already got some clients from around the world, and the feedback's been phenomenal. We've never had, there's a 7-day money back guarantee. We've never had somebody ask for it back. What we've had in that 7 days, the first call, people go through their portfolio if they've got one, and then at the end of that week, narrow down the stocks they should be owning, the ones they should be ditching, based on their own risk profile and based on the data that they have access to, and then that's it. And then they usually have about 1 call a year, maybe 2 or 3 emails in between, and that's it. They can have as many calls as they want. But we think that model is phenomenal. We want, given that we're on the hedge fund side, we really want to shake up the retail fund management side. And I think the best way to do it is not by just being another retail fund manager, but is actually doing something completely revolutionary instead. Any questions I've missed, people? Is there anything that I have missed from this at all? As you sign up, let me know as well, because a few of you have come through already, and I will give you a shout out. Have I seen any question? I'm just going down. Simon, what's view imaging? Oh no, we've done that one. Jeffrey, thanks. Julio, no. Amazon, no, there's no ongoing charges. You can do it by installments, or you can do it all in one go as well. Yes, my LinkedIn is here. Do follow me on LinkedIn. Okay, I'm on LinkedIn. Do follow me on there. If you're a client, connect with me. If you're not, just follow me, please, because with clients I'm in direct contact, and you'll find that's a good way of also staying in touch with me on LinkedIn as well. Have I missed something at all on this? And if I have, let me know. Yeah, you can have as many calls as you wish. What you find is once you're happy and settled with your portfolio, you don't need lots of calls. It's as simple as that. So that's how we can do it. And it also is the confidence that we have in what we're doing. And we think it's revolutionary, because I don't think anybody else does both the hybrid part, the blended part, where you've got the human connection and the data. See, people either do, oh, here's a load of data, go figure it out yourself, and we'll do the occasional webinar, yawn, or they do human only, which is give me your money, I'll manage it for you. And we think you should manage your own money because nobody cares more about it than you, but you should have the tools. And then a fund manager saying to you, okay, let me teach you what you should be doing, a bit like a driving instructor, until you're fully confident and giving you all the education. We think that's the way to go. And like I said, that's why, because it ticks every single box and nobody else does. And that's why we think it's something which is going to be worth hundreds of millions, if not billions. And I think it's a lot more genuine way of doing it, authentic way of doing it, than going through retail fund managers. Where would you recommend to buy data from? Data, look, free Yahoo Finance should have a load. So have starting points that. What are the different plots in MACD, monthly and weekly? Monthly and weekly charts on MACD is what I was looking at. And I'm going to do the update later, which will be on my YouTube channel and it'll be on my Telegram. So keep an eye out for my weekly stock market update, which will be on shortly. Right. If I've not missed any questions, I'm going to go because I think I've answered all of them. And thank you everybody who signed up as well. By the way, 86% of you think the Dow will be even higher than it is now. So I'm really delighted that we've got a good number which have signed up. Thank you. I will email you later. Oh, if it's not going through, just leave it a second because it might be that there's a few people on the page. And that's why I think we've still got 2 left. So if it's not gone through, do wait. Let me just check. I think we've got 2 left. I've got to tap this in and see. But you should be fine. Okay. And any questions at all, I'll leave one more. What I'll do is I'll leave the question chat thing on so that you can still keep asking for a bit if there's any questions about anything about the markets. And what I'll also do is go backwards so that you can see the slides, and just as a reminder, which might sort of give you a few more ideas of questions if I go backwards. Okay, there we go. So that's us backwards. Anything that comes to mind, then let me know. All right. Gillian, you can do installments and you get access to it straight away. There's installments. That's the installment part. And it's 18 months, but you get access straight away. So there's 2 ways of doing it. And as I said, one of them is installments. On this, for the webinar, there is a 40% off when it's webinar, because I know I've got time during the webinar. Otherwise, I don't do webinars. Whereas outside webinar, it'll be no 40% off. So that's £10,000 off, and it's yours for life. And same with the installments. It's the 40% off that you can see there from the fits in with the coupon, and that's the coupon for the off, and that works during the webinar. Outside the webinar, it won't work, and you pay full price, I'm afraid, because then you're paying more for more time, limited time that I have. There we go, and I'll go backwards, and I want to show you all of this, and hopefully you found it all helpful. Arjun, my pleasure. Thank you all very much. I am going to, some of you sent private Q&As, which I'm answering at the same time. What are the, oh, I've done that one, so that's fine. Right, wishing you all well. Thank you all very much. Thank you everybody who's joined up. I think we've got a full house now. In fact, we have got a full house, so that's all gone. Thank you, and I'll speak to you on the other end, and I'll do the market update later on today as well. So thanks one and all. And for those of you coming to my event that I'm hosting at the House of Lords next on climate change on Friday, 26th, I look forward to seeing you there. Thank you all very much indeed. Oh, Harry said can't see where to sign up. Sorry, Harry. It's I'll reply back here. Let me just send it to you. www. I'll put it here. Sorry, Harry. It's alpeshpatel.com/shares2. That's where you sign up. /shares2. alpeshpatel.com/shares2. Oops. He says having overshot. There. That's where you sign up. Apologies, that wasn't clear. And I'll send it to you. Can I book a call to confirm sign up? Yeah, Mike, that's no problem. I'll email you straight after this and we can do that. That's not a problem.